It is time for a bit of an exchange video, mostly because I'm tired of answering the same questions. So in this video here, we're going to be going over how to actually use some of these exchanges, what to be aware of, how to actually enter in your orders, all that good stuff. And I want to preface this whole conversation by saying, hey, if you're new to trading, don't leverage trade. Also, just don't trade in general if you're new to trading. Use what's called a testnet account or a paper account, or in this case, a simulated account. I'm actually using one right now exactly for this demonstration. Not real. You can see its testnet right here. This is for the exchange Phemex. I've actually met their CEO, and he seems like a pretty reasonable guy. He's actually a former JP Morgan guy, and they, well, have sold me on the fact that they actually are trying to play by the rules and stand the test of time, which actually kind of means a lot, you know, when you are talking about most of these crypto exchanges which offer up 100x leverage and all that good stuff. Of course, I should let you know before we even get into it, I do have a link in the description below. It is a referral link, gives you a reduced trading fee so you can, well, not have to waste so much on your fucking orders and whatnot. And then also, there is a deposit bonus for I think 1,200 or whatever. Again, I do feel very adamant about saying this. If you're new to trading, don't bother trading on a real account. Use a testnet at most. That way you can get some experience and not lose your finances, which is a good way to be handling things in my opinion. Anyways, first and foremost, this is the face of the exchange right here. It's going to be pretty this is going to be pretty consistent amongst all exchanges that I've pretty much dealt with. And I imagine that, well, there's no real need to change them. Anyways, first and foremost, what do you need to be aware of? Well, you got a chart right here. Of course, if you are very serious about trading, you're probably not doing your charting on the exchange chart. You're probably doing it on TradingView or something similar in this case. You're probably also not trading SHIB token, which I just made a video on. Anyways, let's go back on over here. Let me just pull over my tab so it's nice and easy to reference. And let's get on to the next thing. Okay. So what's the next thing that you need to be aware of? Well, the order book right here. This represents all of the current orders that are available for the underlying asset that you are looking at. In this case, we're looking at Bitcoin, and you can see the current best bid and the current best offer, this being your offer side, this being your bid side. And in this case, it also shows you the depth there as well, meaning that is the amount of contracts available in the books that are put there as limit orders. So this is not necessarily representative of what's actually liquid at those prices. Obviously, you can have what's called hidden orders, iceberg orders, all that good stuff that essentially won't show the actual or the full quantity. And instead, they will get hit and you'll see it over here in the recent trades list. So in my opinion, and in my experience, the order book over here is not that relevant because those orders can be pulled at any moment in time. Again, they won't show the actual orders that actually move this market, which are called market orders, and they won't show hidden orders as well by definition. What will show everything is the recent trades list. These are trades that have actually gone through. You can be assured that these are real, and you can be assured that, well, they've been filled. That is the only reason why they'd be here. These ones over here are kind of like, you know, possibilities essentially. And again, they can be messed around with and manipulated very, very easily. This is what's actually real. This is what is potential, but not real. Anyways, okay, cool. So we've gotten through that. Now, of course, probably the most relevant thing to be speaking about is your orders, right? So there's two major different order types that you're probably going to be mostly using. There's limit orders and then market orders. Okay, first things first, market orders. Market orders, as this tab does suggest, essentially immediately get filled at the best price available at that time. That's what's coming through on these recent trades over here. These are not limit orders. Not a single one of them are. They are all market orders. And again, when a market order essentially is executed, all you do is you put in the quantity right here, how much you actually want to, well, trade. And as the tab suggests, on this particular exchange, and I believe this is consistent amongst all the major ones, one contract equals $1 essentially. So if you put in one right here, it's not one Bitcoin, it is $1 denominated in Bitcoin essentially. And again, it's going to be executed at market. So let's say that we wanted to buy, I don't know, 1,000, okay? Just random number or whatever. I don't know, we could buy one, we could buy 1,000,000, whatever. Anyways, if we wanted to buy it, we'd press the green button. It's also funnily enough, a motivation for making this video because I've gotten, there must be a lot of new people in this market because I've gotten a lot of big questions about how do I buy or how do I leverage longs? Like you press a green button. How do I short? You press a red button actually. Anyways, this would be the green button. That does mean buy. And so what it's going to do if I initiate this, and we can actually just put it on right now. It's going to be a terrible trade, by the way, because it's probably coming lower short term. But oh, I don't have any balance in there. It's a testnet account and I have no equity. We'll talk about that soon enough. Anyways, assuming that you do have equity in your account, then hitting the green button right here would buy 1,000 contracts at the best offer. So in this case, that would be right here, 63,769. It's changing obviously in a half, and it'll fill as much as available. Now, where I like to operate myself, and ideally I almost never use market orders unless if it is a stop loss, for example, is a limit order. Now, these are a little bit more complicated in the sense that you have to initiate, or sorry, you have to describe what price you'd like your order to be executed at. So this means that if I want to buy at a Bitcoin at $60,000, like the actual price of $60,000, like way down here, then I put that in the limit price tab, and then I put the same quantity. So quantity is the same from market to limit here. Again, just how much you actually want to execute. And then your limit price on this tab is where you want that order to be done at. So there is a nuance with this. If you are putting in a limit order, there's a potential, just like the orders in the order book right here, that it might not get hit. Just because I'm putting in a limit order at $60,000 doesn't mean that the price action has to come down and fill me. In fact, it would, one, have to come all the way down to that level, and then two, you would have to get actually filled by a market order from someone else into your, well, into essentially your bid. So someone would have to sell to you in this case. And there's probably other people ahead of you in the order book. So, you know, it could be that price actually even comes down there and they just, you know, hit the first few bids. But because you initiated your order a little bit later, well, maybe you just don't get taken. It's possible, certainly. Anyways, a few other things right here. Order value just tells you how much that is equivalent in Bitcoin. So if I'm just doing 1,000 contracts, that's going to be 0.0166. If I were to do 60,000 at that level, it should be exactly 1 Bitcoin. Oops. There we go. Not 600, but 60,000. There we go. Lovely. 1 Bitcoin. And then your available balance is going to be the equity available in your account. Okay, right here tells you the cost of that order. So once it gets executed, you pay a fee. You pay a fee essentially. All right, these boxes right here, and the fee is equivalent to this, and that's going to be based off of the quantity. So obviously, if I'm buying 1 Bitcoin, I'm going to pay this. If I'm buying a lot less, you're going to pay a lot less. So that's a massive difference right there, obviously. Anyways, let's now address these ticked boxes right here, of which I have none of them ticked right now. Okay, so first things first, what is post only? Well, as the little tool tab suggests, it is essentially an order that will not execute immediately against the market. And if you use this, you will ensure that you get a maker rebate. What is a maker rebate? It means that if you put in a limit order that is not at market, meaning it is not better than the current offer or bid, depending upon which side that you're on, then you actually get paid when you get filled. Meaning that if you essentially provide liquidity for the market in the same way that a market maker or liquidity provider does, just by the nature of your order being filled. So if I were to put in this limit order right here at 60,000 Bitcoin price, and then let's just say I buy one to make this nice and simple, I will actually get paid for getting filled on that order. Money will come into my account just for getting filled on that order. Whereas if you use a market order, you pay a fee, of course. Okay, so the post only will essentially it will ensure that you will never do better than the market, meaning that you will always be a true limit order and get that maker rebate. So I need to be very careful with the way that I relate this again, simply because if you tick post only, and then let's say we're trying to buy a Bitcoin, we're trying to buy, just 1 Bitcoin. And let's say we say, like we think we're being slick because we don't understand this. And we're like, okay, I got post only ticked. I'm going to put in a limit price that's actually better than the current best offer, and I'm going to get my Bitcoin and get paid the maker fee. Well, then let's just, for example, right now price is trading like 63,700. Let's just say I'm going to do it 64, and I want to buy. What's going to happen is if I press a green button and actually add equity in this account, what's going to happen is that the order will immediately cancel. It will not execute because it is better than the current market value. Same thing on the other side as well. Let's say I wanted to sell a Bitcoin and have that ticked. Well, if I want to sell at 60,000 rather than 63,712, the order is just not going to execute. That's what that does. Reduce only. Very, very important to understand. And what does this do? It means that it will only execute if you have an open position and the next in this order reduces that open position. So theoretically, let's say I was already long, or I already had bought one Bitcoin. If I then try to buy some more, whether it be a limit or market order, and I have reduce only ticked, I will not be able to increase that position. It will immediately cancel as well. It will only reduce my open positions. So if you have reduce only ticked on and you have no open positions, none of your orders will execute, just so you know. This is best to use typically with a stop loss or stop market, stop market or stop limit, as during those times I would assume that you want to reduce your open position. So this will only work in the example that you already are long one Bitcoin, for example, and then you decide to sell and you have that ticked on. It's just going to ensure that you only will sell as you get closer and closer to having no position at all. And if you were to, let's say, sell more than what you already had open, the part of the position that would put you into what would actually be a short position afterwards, as it's more, would actually also cancel. So it'll only get you back to zero. So if you're going to, well, what we're going to speak about next, or actually after this next one, bracket order, then, well, it's very useful for conditional orders. I'll just say that. Anyways, bracket order. This is actually something that I've never really cared to use myself, but bracket orders are designed to help limit your loss and lock in a profit by bracketing an order with two opposite side orders. So essentially, it's a built-in take profit and a built-in stop loss. Personally speaking, I have never really used this because I just will put an order on the other side anyways. I know where I want to take profit. I'll just use another order. But if you want to have it streamlined in that same position, you can do that. So all of these can actually be ticked together, just for what it's worth if you wanted. They're not mutually exclusive. But your target point, that's essentially where do you want to take profit on a limit order. And your stop loss, you can do both a limit or a market, which we're going to get into next actually. But that's essentially where, if price action goes, you would want to lose your position. So let's address it in the better fashion, which is over here with a conditional order. Okay, a conditional order, essentially, and we're going to start with the easier format of this first. A conditional order is essentially an order that if price action gets to your specified level, then an order will be executed. So we're going to first address a conditional market order. So these are also known as stop market orders. And basically you have what's called a trigger price. And that trigger price is what then will initiate and execute a market order by whatever quantity you want. So let's say I'm already long one Bitcoin at 60,000. So I'm in profit by about 3,700 or so right now. And let's say that I want to make sure that I don't want to, give up any profit or maybe, or also don't give up a loss in this case. So let's say I'm looking at the charts right here. We're on an hourly. Say, well, I'm already in profit. Don't want this to evaporate. I see a higher low right here. If we take out that low, I want out. I want to take that profit. You can use it in that fashion. Whereas that low right there, just in the chart, 63,500 or so, we would put in a trigger price of 63,500. And then we would put a set sell stop. Set sell stop, and close on trigger is the same thing as reduce only from the prior explanation. Reduce only and close on trigger, you can understand, is pretty much the same thing. It will only reduce it to 0 on an open position. Anyways, so this would imply if I put this in a sell stop right there, that Once price action gets to 63,500, I will then sell that position equal to the quantity executed right here. It also tells you about leverage and all this good stuff, the cost of it. Now I'm going to, I'll go over that soon enough, but for right now, we don't need to go over that. Anyways, you also notice there is another indication over here, which you can do a limit order. So this one's a little bit more complicated. You're going to have a trigger price that operates the exact same way. And then what you'll have is a limit price. So the way that this works is that if price action comes to my trigger price, then and only then will it execute, or sorry, not execute, but it will put into the order book this limit order right here. And then price action needs to come in and fill that order. So it will not be executed immediately. It'll only be executed at the price that you want. There is a major drawback with these. And there's a major drawback with the other one as well, which we'll go over right now. Major drawback with this, as you might guess, is that, look, I could have the same trigger price, 63,500, but let's say I want to get greedy here and I'm like, you know what, if we come down there, it's probably going to bounce. And if it bounces, I don't really want to sell right there. I want to sell a little bit higher at 64. You can do that. You can definitely do that. The problem is that then price action, after getting first to your trigger price, then needs to go up, in this case, to your limit price and then fill. So you can run into a situation where you do not get filled, and that can be very painful if the market runs away from you after that point. And what was once a good position can turn into a terrible position very quickly after that. By contrast, a market order also has some issues as well. Now, I think that this is a good trade-off, but you be the judge as you are your own authority. But a market order, well, if you want to sell 60,000 contracts of Bitcoin at that price as soon as market gets there, what if the order books right here are very thin? And in order to fill this order, you're not going to get filled at exactly 63,500, but you'll incur what's called slippage. This is a big issue when you have a lot bigger positions. If you're operating with less than $1 million in contract position, probably going to be fine. Market can usually soak that up and absorb that extremely easily and efficiently. But should be said anyways, because a lot of the time what will happen with people with bigger orders when price action is very volatile and violent is, is they will initiate their trigger price and then they'll get filled much further down. Now, we haven't seen some like this in a while. But for example, we saw a lot of this back in May of this past year, where Bitcoin just zoomed to the downside, and what people thought they would have a stop market order over here at about 43,000 ended up getting executed in like the mid $30,000 territory. That is a limitation of that order particularly as well. Okay. So for this exchange, you are offered up to 100x leverage. I will go on a limb here. You never probably need to use 100x leverage ever. However, you should also know the differences between these leverage amounts here. So leverage essentially allows you to trade more, and this can get very dangerous here. So again, this is really only for someone who already has a good history of being successful with trading. You probably don't want to start leverage trading right off the bat. In fact, I would strongly suggest not to at all. Again, I'm not here to be your dad, but I would strongly suggest that. Anyways, okay, so you'll see that there's cross and then all the way up to 100x. The leverage amount allows you to trade that times your equity. So let's say you only have $1,000 in your trading equity account. That means you deposited $1,000. Well, if you use 2x leverage, that means you will be able to put on 2 times the amount of your equity. And so you'd be able to trade $2,000 rather than your $1,000. Now, the problem with this, or the trade-off with this, better said, is that because you are essentially borrowing to trade, you're borrowing from probably like a margin funding pool or a peer-to-peer, something like that, you will have what's called a liquidation price for that position. A liquidation price is going to be the price at which you'll be forced to give up your position and take the full loss. So the higher leverage that you go, the closer your liquidation price will be to the current price action. So if I were to go with 100x leverage, you can imagine with my $1,000, I can now trade with $100,000. However, I will be forced to liquidate that position, meaning get out of it. In the case of buying, I would have to sell, or in the case of selling, I would have to buy rather close to the current price action. 50x, obviously going to be a little bit less than that. 25x, you get it, right? Anyways, cross is what I actually only use myself. Now, cross leverage essentially uses your whole, and this is, okay, and while I'm saying that I use this myself, this is not to say that other people should use this. I want to be very adamantly clear about this. In fact, I'd say that unless you understand what I'm about to say next, and unless you understand how to manage your risk, you are going to literally lose your whole account if you use this leverage and you don't know what you're doing with managing risk. But on cross leverage, what does that essentially allow you to do? It allows you to use your whole account's equity as margin to put on positions all the way up to 100x leverage. So you can trade 100 times your equity and you will get liquidated at the point where you have literally no equity left in your trading account. Meaning that if you get liquidated on cross leverage, you lose your whole account pretty much. Very, very important to understand. That means, that implies that if you do not, or if you're not proactive with managing your risk, you can't use this leverage because you will naturally, at some point in time, lose your whole account as the market naturally goes against us and we can't be perfect with trading. Okay, risk limit. I think that's rather obvious right here, unless if it's not. The maximum value of the position can be adjusted, and different risk limits have different corresponding initial margin ratios, maintenance margin ratios. You can also click there to learn more if you want. Just curious, is there anything that I'm missing over here? Yeah, leverage tells you your leverage right there, cost of the position. Okay, we've got all that. Time in force, immediate or cancel. I mean, pretty much always going to be it for a market order. For a limit order, a little bit different. However, you're probably always going to be good till canceled. In fact, actually, it looks like I can't even change it here. Can I? Yeah, I can. Okay. Yeah, you can. So there's good till cancel. There's immediate or cancel, and then there's fill or kill, or, well, just say out the acronym right there. Anyways, what do we have going on right here? Good till cancel is probably what you're going to use 99.999999999% of the time. It means that when you put that order in, it will be there in the order books until you yourself either cancel it or the order gets filled. So it's kind of like a set it and forget it type thing, if that's what you want. Immediate or cancel means that I will put the order in the order book, and if it doesn't get filled immediately, it gets canceled. A little bit less useful for the average person. And then there's fill or kill, meaning that I will put my order in the order book, and if one market order right here does not fill the full order, the rest of it gets killed. Okay, all right, so we've got all of that right down here. You can see your total balance. If I had equity in this account, it would be right here. And then your unrealized P&L, that's going to be for your positions running right now. And then, of course, for your open positions, closed positions, going to be more or less same here, but basically it's going to tell you the symbol. So in this case, if I'm trading Bitcoin, it's going to be BTC. The size, obviously the contract value that we identified over here. And you have value, that would be the value in Bitcoin. Entry price, that's the price that you entered. So if you're using a limit order, that'd be 60,000 in this example. Mark price, that's going to be essentially the contract's real-time mark price. The mark price may and often does deviate from the last traded price. The mark price is used to calculate profits, losses, and margins, as it is much less susceptible to price manipulation. Essentially, like it is actually a better way of looking at of like the real price, especially on an exchange like this. Liquidation price, that is the price at which you will be forced out of your position. So if you're using any margin at all, or sorry, any leverage at all, there will be some liquidation price for your position that if price action gets there, you'll be forced to let go of that position, incurring the full loss. Margin, that's your margin level. Margin used by current position, or sorry, the margin used by your current position. So if you are using cross margin, it will use the lowest necessary amount of margin to hold your current position. So another one of the advantages of using cross margin is just the simple fact that, well, you can put on multiple positions and hold them. However, again, it's going to eat into your overall obviously account margin, which means that at some point something's going to give. Obviously, unrealized P&L is the profit or loss that your position currently has that is not realized. And then realized is what you've actually closed and has come into your account. And you do that by essentially either having, of course, your, where do we go? Where do we do it over here? Either by having your bracket order already done over here, or you can, of course, just do it with another limit order. So while I did while I never use this myself right here with the bracket order, let's say, for example, I had a 60,000 limit order for Bitcoin. I bought it. I bought one Bitcoin right there. So I'm long one Bitcoin from $60,000. Let's say I just wanted to get out of my position. Instead of doing a bracket order and having a target, a take profit, actually, what I'd do is I just enter in a limit order or a market order at whatever price I want to take profit at. That's my preferred way of doing it. I've never really had a reason to do it either way. Over here, there's a calculator at this little symbol right here. It's actually really useful because you can put in a theoretical position. So let's say I wanted to buy, one Bitcoin, at 60,000. So it's just one. And then I wanted to exit at 65. Okay, calculate. All right, so it's going to tell me my entry value. I bought one Bitcoin, my exit value. So once Bitcoin gets to 65,000, it's no longer one Bitcoin. It's worth 9230. My profit and loss is going to be 0.0769. My return on equity, well, I have no equity in this account, so it's going to be 0. Obviously, you need to have some equity in the account for that to make sense. You do the same thing for a sell over here. Your liquidation price, this will calculate the liquidation price for your position. So let's say I bought 60,000 Bitcoin and I bought it at 60,000 again. So one Bitcoin at 60,000, and I have, let's say I have like 1/10 of a Bitcoin in my account. Where would I get liquidated on this position? So where would, if Bitcoin gets to this area, where would I get forced to sell essentially? 54,794 and a half actually. And then your target price, same thing over here. I'm going to tell you your ROE, which fair enough. Okay, cool. We've gotten through all of that. Let's see. We are 27 minutes into this video. We'll briefly go through the other things as well. Obviously, you can buy in this exchange, like buy your actual cryptos. Select your market over here, of which they have several different, several different pairs. Actually, way more than I thought. Interesting. Markets. Obviously, that's just going to lead you to this page over here where you can see them all in this format. And then products. So we were on the contract trading tab right there. Spot trading is just going to be spot trading. So spot trading is non-leverage, meaning that you cannot get liquidated. And also, if you do have what's called a premium account or a premium trial on their exchange, I guess you also have 0 fees trading. So fair enough. All well and good right there. And I think that pretty much does it. Other than that, I think the only things you really need to know is, how to actually deposit and shit like that. Hey, what? I have equity in this one. Do I? Fair enough. Well, again, this is the testnet, so it's not even real anyways. I'm taking it out right now. Obviously, if you want to deposit, this in this way, it's going to be the same thing, like copy your address right here, blah, 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 blah. That withdrawal, same thing. You got to do the authenticator and all that good stuff, of which, yes, definitely have an authenticator. You don't want to mess around with that. The worst thing from losing your money actually margin trading or just trading in general is to just lose it by having it on an exchange, which you definitely don't want. And then other than that, I think the rest is pretty self-explanatory. So I think that'll do it for this one right here. Again, this pretty much applies to all leverage or all trading exchanges. It doesn't have to be leverage, also spot here too. Just want to get that out there with specific focus on the risk management mostly. And again, I feel compelled to say that, hey, look, if you're new to trading, what you should be doing is actually going onto a testnet account and trying out your strategies there. Do not trade a real live account. There's absolutely 0 reason at all whatsoever to risk your finances during the learning process. And it's a long form game, right? So whether it takes a few months or a year or a few years to learn this as a skill, assuming that you're kind of dedicated towards it, markets are always going to be there. Whether it's this one or another one, it's all the same basically. So hopefully this was in some way helpful. And with that said, I'm going to sign off now. Take care and see you soon.